Ladies and gentlemen, welcome to WealthDown. My name is Noble BM, your portfolio manager and creator of WealthDown. And in today's episode, we're going to talk about risk in the markets. Should you even invest in the markets? Are the markets risky? What is risk? And how you should manage risk. With this being said, don't forget to like, share, and subscribe to the channel, and always click that notification bell in order to get notified when we post new videos like this. So let's jump into today's market events, which is, well, basically German's manufacturing PMI just came out and it was weaker than expected. Just look at the DAX, it is basically falling. So, questions: should you short the DAX? Looking forward on what is going to happen in the week ahead, we're going to have from Australia the interest rate decision. Then tomorrow, also from Germany, the business climate. Again, should you or should you not short the DAX? Then on Wednesday, we're going to have from Australia again the CPI indicators, basically the inflation rate. Then on Thursday, we're going to have consumer confidence from Germany. And then from the States, we're going to have durable goods. And Fed Chair Powell will have a speech again. This will leave us with Friday, where on Friday from France, we're going to have the inflation rate, the year-over-year inflation rate report. And then we're going to have from the US the consumer price index with the personal income and the personal spending. So that would be the economic events for the week ahead. Then we're going to have a quick recap. Let's just take a look at Friday. We did see the S&P hitting all-time highs, but then it dropped, closing the week on a negative note. The S&P reached a peak and then it closed approximately minus 19% of minus 19%. Woo, that would be a recession by that dip. It closed minus 0.19%. Then the Nasdaq also closed negative with roughly minus 0.24%, 24 basis points. Let's just talk in basis points. Again, exactly as the S&P, but the Dow closed positive with only 9 basis points, so 0.09%, 9 basis points. Ladies and gentlemen, commodities today are looking awful. Oil is down, gold is down, silver is down, copper is down, then euro is down. Everything is down, 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 except in the US dollar, which is a bit up. And then we have Bitcoin down and Ethereum up. Actually, Bitcoin was performing pretty good in the European session. So Asia, European session is now blah, 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 as if the market is trying to tell us something. So with this being said, let's jump into, well, earnings. We don't have any earnings. We will have one interesting earnings today, not today, this week. It's going to be Costco. We're going to cover that. And now let's talk about how risky is the stock market right now. So we invest and we expect better than inflation returns. That's why we invest. For the long term, you try to beat inflation and grow and protect your wealth. That's why you're here on this channel. Now, here are some of the key aspects you should take into consideration when investing in the stock market. So first of all, market risk. I also do have a risk calculator. I'm going to launch it on the channel in just a couple of weeks. This is how I calculate basic risk. So there's risk, global risk, and then there's risk for a specific stock if you boil it down. Now, let's talk about market risk. The market risk is the value of your investments, that your investments will go down due to factors that affect overall market. Now, these factors can include economic conditions, interest rates, and geopolitical events. So that's a global risk on the entire market on or a specific stock. Now, there's also company risk. Also, you can read this on the blog page. So visit the blog page on our website and just go through each and every chapter that I have there. Now, that's company risk. When you're talking about a specific stock, this is excellent for overall investing, but also in specific stock investing. So company risk is when the value of your investment will go down due to the factors that affects the company. These factors can include management, basically the management of the company. Then it could include competition or changes in the industry. For example, if something happens to Nvidia or to Jason Wang, not only Nvidia will massively fall, but the entire Nasdaq will fall, and that is also why the S&P will fall. And this is what a company risk could actually influence the entire market, and the market risk can also influence a company. This is kind of convoluted. Company risk can be reduced by diversifying your investments across different companies and industries. So, for example, you could also buy a bit of AMD or buy a bit of Qualcomm, which is going to maybe buy, or everything that is in that AI sector. Okay, you could also branch out of the AI sector for something more secondary to AI sector, which is then energy or the infrastructure system that is going to build the infrastructure for companies that is going to build the infrastructure for managing that energy and upkeeping that energy, because AI needs a lot of juice, ladies and gentlemen. Now, liquidity risk. This is the risk you won't be able to sell your investments, that you will sell them on a minus or a loss when you do need liquidity. And basically, that is why I constantly say, keep a look on Bitcoin. Bitcoin is one of the best liquidity indicators in the last time. I don't know why. Maybe because it's traded 24/7, and you will see when liquidity kind of leaves the market. That's the canary in the coal mine for me. Now, liquidity risk is specifically high for stocks that are less actively traded. What would be a great example for that? I do own a couple of stocks that you're basically not going to see those pulses, but you're going to see up, straight line, hours, maybe hours, then a line down, then straight line. That is poor liquidity. Yes, there's liquidity also means less stock. Yes, stock. If you don't have enough money, if you don't have enough stock, if just not enough supply, same thing. So if there's not enough supply of something, that it not necessarily means that is high price, because it has to be a demand for that supply in order for the price to grow. Inflation risk. We just lived a couple of years on inflation risk, so you should know all about inflation. So inflation risk is the value of your investments, that the value of your investments will go down due to inflation eroding the purchasing power of your money. This is why we invest for the long term in order to protect us from inflation. Now, inflation risk can be reduced by investing in assets that have historically outperformed inflation, such as stocks, real estate, and commodities. There you go. So next up will be interest rate risk. Interest rate risk is that the value of your investment will go down due to changes in the interest rate. For example, as now we are seeing rate cuts and the money markets are paying less and less money on your cash. Interest rate risk is higher for investments that are sensitive to interest rates, such as bonds or real estate. You saw that I bought, if you watched the weekend edition of the show, where we're doing a portfolio review, you saw that we bought bonds. Go and watch the video. I'm explaining why I did that. Actually, a ETF, which is reverse to bonds. Prices go, or rates go down, prices go up. Prices go up, rates go down. Or the rates goes up, the price goes down. Watch that video. I'm explaining that there. Now, interest rate risk can be reduced by diversifying your investment across different asset classes. Watch the video. I'm explaining why I bought that specific ETF. It's not just a regular bond ETF. I'm going to link it down in the video description. So, currency risk. Currency risk is the risk that the value of your investment will go down due to changes in the exchange rate. Right now, euro and the Japanese yen both have currency risk. Currency risk is higher for investments dominated for foreign currencies. Depending what you consider foreign, but for example, for me, the dollar would be a foreign currency. Also, the Japanese yen would be a foreign currency. Euro is native currency. So dollar would be riskier, although dollar is the less riskiest currency for me, but currency risk. There you go. Political risk. This is exceptional. Political risk is the risk that the value of your investment will go down due to the changes in government policy, regulations, and political instability, as we are seeing all across the globe right now. It seems that the most stable political countries would be China and Russia. Geopolitical risk would be the next one. The risk that the value of your investment will go down due to conflicts or tensions between countries, such as trade wars, sanctions, or military conflicts. Do I have to say something about this? Geopolitical risk is higher for investments that are due to the global politics, such as commodities and international stocks. Okay, cybersecurity risk will be the last one. The risk that the value of your investment will go down due to the cyber attacks, data breaches, or cybersecurity threats. One of the biggest example for this would be, although it wasn't an attack, but would be CrowdStrike. CrowdStrike is security, and if CrowdStrike fails, the stock goes down, as we saw a couple of months ago. Cybersecurity risk is higher for investments in companies that are vulnerable to cyber attacks, such as technology companies or financial industries. Okay, now how can we manage risk? That's our job here, to manage risk. That's why we're investing and we are trying to grow and protect our wealth. The direct outcome of managing risk will impact your wealth. Now, diversifying your investments across different asset classes, industries, and geographies. Diversifying can help reduce the impact of market, company, and other risk of your portfolio. Now, across the globe is pretty tricky if you're in the current state of conflict. Normally, yes, it would be recommended to have also a bit of emerging markets in your portfolio, but it seems that owning gold and Bitcoin is performing much better than emerging markets. So own the S&P 500 and gold and Bitcoin. That's enough. Also some rental properties. Investing for the long term. The stock market can be a volatile place in the short term. We kind of saw that in the last couple of weeks, but tends to perform well over the long term. By investing for the long term, of course, you can reduce the impact of short-term market fluctuations on your performance. Next up will be to monitor your investments regularly. Now, this does not mean that you scroll all day long on your devices and just check your investment account. No, keep track of how your investments are performing and make adjustments as needed. As needed would be here the key word. And of course, consider working with a financial advisor. This right here is a channel where I go through my thought process and give out all of my information on how I manage my portfolio, our portfolio. This is not financial advice, and I'm not a financial advisor. Seek the help of a professional financial advisor. This is just information that I give up freely so people can educate themselves and make up their own goddamn mind. Now, a financial advisor can help you develop a personalized investment strategy that aligns with your risk, tolerance, and financial goals, of course. Now, there are a couple of more, but I do suggest that you go ahead and read the complete article that I have now it should be live on the website as soon as we finish recording this video. So stay informed will be the next one. Be patient. Consider using risk management tools, as I do. I created my own tools because I know how to program. Prepare for the unexpected. You cannot prepare for the unexpected, but you can be prepared for the unexpected by knowing that unexpected things will happen. So keep calm and move on. Stay disciplined will be one of the biggest one. Seek professional advice, as I said. Stay focused on your financial goals. Set your goals, focus on them. If your goal is to beat inflation, focus on beating inflation. If your goal is to be a gazillionaire, good luck with that. Be prepared for losses, of course. You will lose money. That's just how I have heard and I have read actually the best advice on how to manage losing money by paying fees. So fees are actually losing money because you had money, now you don't have money. But you can manage that feeling of losing that money that you pay or will be taken from you due to fees by just acknowledging the fact that sometimes you need to pay the money gods. Okay, the money gods need to be paid. If not, they're going to come down on you with big vengeance and they're going to take all of your money. And last but not least, stay positive. Have a positive attitude. Actually, there was a research that in the past 30 years or something like that, over 70% of those days were where the market closed on the positive side, meaning that the market is more up than down. Okay, when it corrects, then it really corrects, or it doesn't have to be such a big correction, but markets tend to be more on the positive side than on the negative side. So just stay positive and stay invested. So in conclusion, stock market. The stock market, it is a risky place to invest, but it can be also a very rewarding one. By understanding the risk and taking steps to manage them, you can increase your chances of success and achieve your financial goals. Of course, if you set them. But if you are unsure on how to work or invest in the stock market, then I would suggest that you work with a financial advisor, the best risk management that you could do. Okay, so with this being said, thank you so much for watching. Come by the website, check out the blog post. Please like this video. It really helps out with the channel. You can see I'm a really small channel right now. Really would love to grow, become bigger, put some water on me, give me some like, subscribe to the channel, click that notification bell. With this being said, I'm Novin BM. Wishing you to stay safe out there, manage risk. Have a lovely day. Stay positive. Bye-bye.